Welcome to the TrustleBridge Capital monthly video series entitled Know What You Own. I'm your host, Eric Jefferson, and for this month's installment, we're going to focus on the concept of high quality stocks. I'm going to first explore what they are, how you screen for them or identify them, and then more importantly, discuss different market environments we think they may be rewarded. Now, before we get started, have a few quick words from our legal team. With that, we can go ahead and dive right in. As I do, I'd like to first begin by defining what are high quality stocks. Quality is a factor or a characteristic of a stock, no different than, say, size or style. There are large cap and small cap companies. There are those that are more growth or more value oriented. Certainly, there are those that are higher or lower quality. Now, when you think about what makes a company quality or not, certainly each individual is entitled to their own opinion, but the three most widely accepted attributes of high quality, as you can see outlined below, are profitability, moderate degrees of leverage, and steady and consistent earnings growth. Now, beneath each three of those, we have the actual metric that our industry will use to go through analyze thousands of different companies, different metrics and variables in order, in essence, to rank or prioritize, categorize which companies screen the highest for exposure to a particular factor. Now, you think it may seem obvious that more profitable companies with consistent earnings growth would be better investments long term, but as you actually look at the data, you can see that's not necessarily the case. Going back to the inception of the S&P 500 Quality Index, going back to June of 2016, you can see over that time period that the regular S&P 500 index actually outperformed by about 8%. Now here we're talking about roughly a 8-year period, so 1% in a given year, not making a huge difference. But when you think about the different environments, you would want to own the more speculative names within the S&P 500. Those tend to be more rewarded in broad risk-on environments. It tends to be those safer, higher quality that outperform that you would want to own in more volatile or potentially challenging times. As you can see here, two examples up on the screen. Again, comparing the S&P 500 versus those companies that screen the highest for quality. We have the period for COVID on the left. We have 2022 on the right. Both of those periods very difficult for risk assets. As you can see in both of those, the S&P 500 quality names not only held up much more better on the downside, but also had better total returns. So as we think about the landscape ahead, certainly if we continue to be in a broad risk-on, speculative-driven market, that's where we see a lot of those high-profile, really expensive technology companies continue to be rewarded. That is more of an environment where having that broad exposure to all 500 names within the index is likely rewarded. If, though, do anticipate that there might be some choppier, potentially more challenging times ahead. Not that anyone is necessarily calling for double-digit pullbacks, but if we did have a choppier market environment, quality is one of those themes, one of those factors that, if included in a portfolio, may, at the margin, again, only a few percentage points or two, but at the margin, result in a more consistent investor experience. By consistent, refer to better protecting on the downside and offering slightly more upside potential. I hope you enjoyed this month's call. As always, please don't ever hesitate to reach out with any questions. If you don't connect, have a great rest of the week. Take care.